Hello, fellow traders. I'm Dylan, a research strategist at Pepperstone, and I'm here to provide you with the latest weekly update for As Good As Gold. In general, it seems that people have become less responsive to the flow of information compared to the previous week. With resilient US economy performance, we can see a decline in the price of gold after briefly touching the $2,000 mark. In this video, I will give you a brief overview of how precious metals have been performing, the technical aspects of gold against US dollar, the factors influencing recent changes in gold prices, and finally, the key events to keep an eye on for the rest of the week. So when we look at the performance of precious metals as a whole, unlike the across-the-board rally of last week, they have shown divergence over the past 5 days. Platinum stands out as the best performer, having increased by 3.2% against the US dollar. In comparison, the appreciation of gold's price in dollar terms has been limited, with only 0.3% increase. However, when traded against the Japanese yen, one of the weakest G10 currencies, the upward price movement has been significantly larger, reaching 1.2% over the same period. And silver and palladium, on the other hand, have lagged behind. Now turning to the technical analysis of gold against US dollar, after the rapid rally triggered by unexpected events like Middle East conflict and the US government shutdown crisis earlier last month, the strong upward trend has started to lose momentum, with some bearish sentiments creeping in. Gold against US dollar hovered around 1981 for nearly a week before finally breaking through the psychological resistance at 2,000 US dollar last Friday, briefly reaching as high as 2009. However, the price dipped on Monday, briefly revisited 2,000 US dollar yesterday, but the trend reversed itself shortly after, with the price now testing the 1981 level from above. Should this level fail to provide support, we can expect some buyers to step in around 1952, which is the local high from September the 1st. The second potential support is 1910, the local low from early July, and this also corresponds to the 61.8% Fibonacci retracement level from the previous 3 months downward trend. On the upside, 2009 should serve as a promising resistance in the near future. As for the driving forces behind the recent price movements, there are a few key factors to consider. First, people have become less sensitive to developments in the Middle East, as I mentioned at the beginning of this video. While geopolitical concerns are still present, the increased involvement of the United States in the conflict and the lack of significant developments related to the energy supply disruptions have led investors to become less anxious as they gradually price in the worst-case scenarios. Gold, traditionally considered as a safe haven asset, has started to lose its appeal. Second, traders have decided not to let the fear dominate their decision-making, and other factors like the opportunity cost of holding gold, the performance of the US dollar, and other traditional considerations have taken precedence as geopolitical concerns have receded into the background. The US dollar index has been trading in a wide range between 105.36 and 107.33 without significantly directional movement over the past month. However, recent developments such as the election of a new speaker for the US House, higher than expected Q3 GDP figures, a new high in the US City Economic Surprise Index since August, and also the resolution of auto strikes suggest that things are falling into place and the fundamentals of the US economy remain robust. If there are no unexpected negative surprises, people might shift some of their exposure to the US dollar after the FOMC meeting and also the non-farm payrolls report. On the other hand, the dovish change in rhetoric regarding the YCC policy during the Bank of Japan meeting yesterday frustrated the market again, resulting in a sell-off of Japanese government bond. In contrast, US treasuries, especially on the short end, received a boost. While correlations have been lower recently, strong movements in US Treasury still pose a threat to the price of gold. Looking at the yield of the US 6 months and 10-year Treasuries, 5.57% and 5.08% are still relatively high from the perspective of gold bulls. Given the promising economic conditions in the US so far, some investors might opt to hedge with the US dollar instead. So, in summary, with the positive news coming from the US and the absence of game changing updates from the Middle East, gold is losing its appeal. Whether the price reversion continues or gold surpasses 2,000 US dollar again depends on the outcomes of the FOMC meeting and the non farm payroll report. If the Federal Reserve maintains its hawkish pause and keeps interest rates unchanged in line with the market consensus, the dollar index may see reduced report, ultimately boosting the price of gold. The Fed's decision on whether to proceed with the interest rate hikes fundamentally depends on whether the cooling of the labor market and the wage growth is substantial enough to alleviate inflationary pressures. As a result, the US non-farm payrolls on Friday is also a significant focal point for the market. I believe that if over 250K new jobs are added, there is a slight improvement in the unemployment rate and the average hourly wages remain unchanged. This could potentially create the possibility for the Federal Reserve to raise interest rate in December, which might drive up the value of the US dollar and in return harm the gold price. So that's all for this week. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading.